Good evening, everyone. Welcome to the monthly telecon chat, webinar, whatever we call it. We've been having this series for the last several months. The focus this time is on the surging IPO scene in India. And needless to say, we've seen some blockbuster IPOs, some not so great companies also tapping the markets and getting huge response. There's a SEBI paper actually few weeks back by one of the members, which talked about how the demand for paper in India is twice that of the existing supply. So we're talking about literally lakhs of crores of demand that is there today, the way things are. Obviously, there's a huge buoyant domestic market, DIs are very active, etc. But we just wanted to take a long-term perspective, a wide-angle view of how IPOs have started, what is the genesis in India, what are the ups and downs that this whole the industry has gone through. IPOs were hot, then they were cold. Now of late they're very hot. So what is driving these changes, and is it prudent for investors to get in, with large chunks of money? First of all, is large chunks of money possible, or is it a game of lottery that we are playing, that people are playing? And how does this bode for a long-term investor? So these are some of the things we'll touch upon, and towards the end I'll also talk a little bit about our how the Maxiom Wealth. I mean, we've been telling about this. We've changed our brand name from Jama to Maxiom. So we'll talk about how some of the Maxiom strategies have been doing over the last few quarters and few years. And then obviously there'll be some time for questions and answers. So without much ado, I'll pass over the baton to my friend and colleague, Manoj.
Thank you, Ram. Good afternoon, good evening, everyone. So today's topic is about IPOs. And as Ram said, and those of you who are familiar with my style of explanation, you know that we will go little slow, we'll go back and try and understand at the root level what the issue is and how things work out. So at the, let's start with understanding what exactly is an IPO. Okay, now everybody knows IPO is initial public offer. Now this word initial is important. Initial means first time a company is approaching the public for funds. So any person can start a business, and because business needs funds, that is capital or money, depending upon how much one can invest, you seek others to be your partners. So let us say me and Ram decide that we will diversify and start a Pani Puri business. Then we'll have to chalk out that, okay, how much money are we going to raise to, how much money are we going to need to start this Pani Puri business? If it's going to be a street side bandi, then maybe 15,000-20,000 rupees is sufficient. And if we want to start a parlor with air conditioning, etc., maybe 1.5 lakh rupees would be sufficient. Or if we are planning to start a chain all over India, say Manoj Ram Pani Puri Limited kind of a company, then we'll need lot more money. And when you need more money, the first people who help you out is your family and friends. So you ask for people who trust you, who know you, who believe in your ability, they'll fund. But if your requirement is very large, then probably you will need a lot more people contributing relatively small amounts of capital. And that is when you approach the public. Okay, so when a company approaches the public for the first time, that is when we say a company is coming for an IPO. Post that, every time a company can approach public for funds multiple times. There is no restriction, but every issue after the first issue, second issue, third issue, fourth issue, whatever number of issues, is called a follow-on public offer or an FPO. In terms of operations, etc., everything is same, but an IPO is different because a lot of information about the company is not known, and it is the first time it is coming into public domain, and therefore an IPO has a different flavor to it than an FPO. Okay, so now let us understand how this IPO culture started in India, and that is very important for us because that is the basis for as to why the IPO market is the way it is. So we have to go back all the way to the 1970s, when for the first time a non-Congress government was formed at the center. So the Janata Party, which was, let's say, socialist and nationalist, went after the MNCs. Many of you might be aware that companies like Coca-Cola, etc., were operating in India even during that time. And these were 100% owned by, obviously, the holding companies, US-based companies, where they would sell their products in India and make money, but there was no production, there was no activity, so a lot of, India as a country was not benefiting. It was only proving to be a market for these companies and nothing beyond that. So the Janata Party government insisted that if an MNC wants to operate in India, it has to compulsorily offload a certain stake in favor of the Indian public, meaning every company has to have necessarily an Indian ownership. So that was one of the reasons why companies like Coca-Cola decided to leave India, because they didn't want to dilute their ownership stake. But a lot of other companies, for example, if you remember, you still know the brand, there's Bonds. Bonds was a company at that time. Okay, the tea that we drink, Brook Bond, was a company, Brook Bond India. Like that, we had multiple companies which chose to remain in India, and they said, okay, we will dilute a small portion of the equity in favor of the Indian public. But the Janata Party government did not stop at that. They said, you can't sell the shares at whatever price. They put a restriction on the price at which you can issue the shares. And understandably so, the price was very, very low compared to the valuation of these companies in the global markets, etc. Even accounting for the fact that these companies catered only to Indian markets, etc., still the pricing of these shares was very, very less. Again, as our, many of our investors might know, very senior doctors, who bought shares of Ranbaxy and other companies because of AstraZeneca and many of these multinational pharma companies, as part of, their efforts to reach out to doctors, etc., made these doctors subscribe to these shares. And as you know, these shares were actually multi-baggers. The people who invested in these companies made huge amount of money. Again, we had two categories of investors there. Because the shares were very underpriced, the moment the shares listed on the stock exchange, they shot up. And whoever got the allotment made a huge profit on listing itself. And therefore, many people chose to sell the shares on listing and make quick money. And this money was huge. And if you calculate the return percentages, that will shoot through the roof. And people got a kick of this. The second category, of course, were people who invested and remained invested in these companies. And they made insane amount of profits. And some of them who are still holding would have become multi-crore patis just because of the same amount of, because they did not sell their investments. But we are talking about the first lot where huge amounts of money was made in a very short period of time, and this gave kick to the public. They said, oh, if somebody wants to get rich quick, then what they have to do is to participate in IPO Act. And slowly, 1977, I think Reliance came up with a public issue. And the issue of Reliance was quite large by those standards. A lot of public, again, relatives or known people of Dhirubhai Ambani, etc. But nevertheless, people made a lot of money at the time of listing. So the widespread knowledge at that point in time was, if you want to make money, then stock market is the route. And stock market means not secondary market, just invest in IPOs and then sell it on listing. And keep rotating this money. The reason why people made a lot of money was, at that time, we used to have a body. SEBI was not there at that time. SEBI got created in 1992 when we started the economic reforms. Prior to that, we had a body called Controller of Capital Issues, popularly called as CCI. So the Controller of Capital Issues would dictate the price at which you could come up with an IPO. And again, this price was very, very low compared to what the worth of the company was. So easily people would expect 25-30% return on listing itself. And that prompted many people to invest in IPOs. And a lot of controls that we see today were not there at that time. So I will invest on my name, my brother's name, my sister's name, my father's name, uncle's name, daughter's name, son's name, whichever, or friend's name, whoever is not investing, I'll say, please fill up one form. I will make the payment. When you get the shares, you give it to me. That kind of, because it became a lottery system. There's nothing to lose. You simply invest the money for a period of, at that time, it used to take more than 3 months. You block your money for 3 months. And if you get the allotment, it's a bumper lottery. If you don't get the allotment, your money comes back. So no risk, and you would get huge amount of returns. Now, what happened post this was that after we started the economic reforms, the Controller of Capital Issues was scrapped and SEBI was created. And SEBI came up with a lot of capital market reforms. One of the things that was very obvious was that pricing is very low. A company is losing money because it is forced to sell shares at a lower price. So SEBI said, okay, we will not have this cap on valuation. If the investor thinks it is the right price, they will invest. If they think that it is overpriced, they will not invest. We leave the judgment to the investor. Now, in principle, when we talk about it, it looks very sensible. But the reality is, people didn't know what is happening. Nobody bothered to know what regulatory changes are happening. People were used to simply investing in IPOs, getting allotment, selling at listing, making huge profits, and then rotating them. But post this regulatory change, companies started issuing shares at much higher prices. You will be surprised to know, at one point in time, we had close to 500 merchant bankers. And these merchant bankers would compete with each other to get the order from the company, saying that I will get you a better price. So I will help you raise more money by offloading only lesser number of shares. And to make this a reality, the merchant bankers did a lot of quote unquote not so market friendly activities. Clearly they were involved in rigging of prices, and they had that pressure to show listing gains. But obviously it doesn't work with everything, and there are a lot of knowledgeable people who knew that the shares are overpriced, and therefore the moment the company got listed, these people would heavily sell those shares. At that time, there was a system of badla, which is again similar to our F&O market where you could short sell. And what happened was, instead of huge listing profits, investors started experiencing huge listing losses. Some of you would know that a company like Infosys, which was one of the most revered and respected company, the bellwether of IT industry, etc. Infosys could not, IPO of Infosys was a failure. People did not invest in Infosys. The reason was because people were worried about listing losses. People didn't know how to evaluate a company, whether this is a sound investment, not a sound investment. It was just herd activity, and Infosys issue got bailed out only because it was underwritten. Now, underwriting means it is, without going into too much of depth, it's kind of insurance. A merchant banker tells the issuing company, look, I will sell your shares, but if for any reason we are not able to get the subscription, whatever shortage is there, I will make good so that your issue does not fail. So the underwriters had to pump in money and make the Infosys issue successful. So what was happening was, a lot of the interest in the IPO market and therefore investment in equity almost dried up. And then we had a spell of a period where there were many frauds. Again, merchant bankers being hand in glove with company, etc. There was this popular case of MS Shoes. Okay, a company which was not very great company. But they branded themselves as, we are exporters of shoes and other footwear with operations all over the globe, etc., etc., etc. And no less than SBI Capital Markets were the merchant bankers. The share prices were heavily rigged, and what was 28-30 rupees, the price was taken to 500 rupees plus. See, we are talking about 1990s, and this is a huge, heavy amount of market manipulation. And people lost very badly. And this almost sounded the death knell of IPO as well as equity investment. You might have heard many seniors, your parents or grandparents, depending upon your age, saying that do whatever you want, but please don't invest your money in stock markets because stock markets are risky, because they have gone through this period where investors were taken for a ride. So as a result, SEBI came up with various regulatory measures. So, today, not just any company can come in and offer shares on an IPO basis. There are certain criteria. There's a criteria of profitability, there's criteria of net worth, track record, who are the promoters, etc. Earlier, there was this fancy trend of just changing the name of the company. Let's say I'm a finance company, but I'm seeing that a lot of IT companies are doing well, they are getting higher valuations. I'll change my name from Manoj Trivedi Finance to Manoj Trivedi Infotech, and my shares will simply shoot up. So SEBI said, no, this is not possible. At least 50% of your revenue should come from that new name or whatever. Another significant change that SEBI brought in was huge increase in disclosure requirements. Earlier, when a company came for public issue, there are hardly 7-8 pages of information that was given. There's no information practically about the company. People would simply rely on the word of the broker and invest. Today, there are so many disclosure requirements that your draft red herring prospectus, DRHP, that we talk about, and we'll understand what this prospectus is also. The draft red herring prospectus runs into 500 pages. And we know that it is too much of information. People may not be interested. And a lot of this is because companies started taking legal help. went to legal guys to say, okay, please draft our prospectus properly. And legal guys have their own way of expanding the language. So, the volume simply increased. So SEBI said, no, nobody is going to read this. You come up with a abridged prospectus. Even the abridged prospectus today runs into about 100 pages. And nobody has time. We are in the world of shorts and reels. So nobody has time to read 100 pages. So today it is very difficult for an investor to actually look for information from even an abridged prospectus. Okay, SEBI has done its job. What it is saying that, okay, we will provide you all the information and investment has to be done wisely. See, we all have to understand a regulator does not guarantee profits. It is not the regulator's job to make sure that investors make money. Investing involves making profits as well as making losses. Regulator is not responsible. What is the regulator's job? Regulator's job is to ensure that people are not taken for a ride. People are making a wise and informed decision and not based on misinformation or wrongly created information. So, if you are investing in an IPO, you know that there's not much of information. So if you want that information, then you have to go through these hundreds of pages of information that is there in the prospectus, and then only you will be able to take an informed decision with respect to whether I should be investing in IPOs or not. So what we have seen is that most investors, particularly retail investors, do not have time or skills to actually go through this entire process. So the IPO activity has largely been a herd activity. There's a very strong correlation between secondary market performance and IPO performance. So if the secondary markets are doing well, then people are very optimistic that we will have listing gains, and therefore people investing IPO market. So ideally, if you are investing in IPO, the criteria of investing should be the same as criteria of investing in secondary markets. However, the single largest driver of IPO market is the possibility of listing gains. And here we have very smart companies, these banks and financial institutions, who will come and offer finance. IPO financing is a huge business for banks. They'll say, sir, and what was 3 months earlier, 3 months of blocking money, now the cycle has been cut down to about 7 business days. So take it as 2 weeks. So your money is blocked only for 2 weeks. And there are provisions like ASBA, where for retail investors, the money is not even going out of the bank account. Your money is there, but it is blocked. You can't use it. That's all. But, because this is a lottery system and you want to increase your chances of investing, the bank will come and say, sir, why are you investing only in retail? There's another category called HNI where you can invest a lot more amount. So you can increase your probability of getting allotment, even though the proportion wise it is lower. So there are some nice calculations. They say, okay, this is our rate of interest for 2 weeks. The amount you pay as interest is only this much. But even if you get minimum quantity, this much of listing gain, so you make a huge amount of profit. So all these stories are told and people go for IPO financing also. And that is the reason why you see issues getting oversubscribed hundreds of times. Because a lot of money, including borrowed money, is being invested into IPOs. Another trend is that every company will fancy its chances of hitting the IPO market and making money while the markets are still going. So you have shady companies approaching the market and getting away by getting fancy valuations, and they make huge amount of profit. And then after the tide has turned, the investors are left with huge losses. Now, does that mean we should not be investing in IPOs, or should we consider investing in IPOs? So as I said, there are two types of people, investors. One who are looking clearly for listing gains. And as I said, whether we like it or not, that is the biggest driver of IPO markets. Then there are other category of investors who are looking for investment in sound companies for a longer term, but they would definitely want to tap the IPO market because they know that there is a likelihood of getting the shares at a discount. You want a good product, but there's nothing wrong in getting a good product at a relatively lower price. So if there are listing gains to be made, why not take advantage of that? So there are two types of investors, but we are largely talking about the first lot who say what is wrong in trying our luck. After all, it is 2 weeks time. I put the money. If I get it, I'm happy. If I don't get it, no problem. The opportunity cost is very low. So logic is right, but there's one risk that you need to be aware of. Now, when you invest in a stock, and particularly in current times, what has happened over the years is that the volatility in the market has gone up significantly. So today, we have huge fluctuation in markets on a daily basis. Any negative news or positive news can pull the market in either direction significantly. Okay, percentage wise, it may be only 3%, 4%, etc. But you will see Sensex falling or rising by 2,000 points, 3,000 points. On budget day, Sensex fell by 6,000 points. So these are large numbers. And particularly if people are looking for those listing gains by funding through IPO financing, etc., they are taking a huge risk. Now, I will give you an example of a company which you would have all heard of, the pioneers in low-cost airlines, a company by name Air Deccan. A movie also has been made on this company and its promoter, and it started with a very noble intention of providing the opportunity of flying even for the common man. So 1 rupee tickets were offered, 99 rupee tickets were offered, etc. Anyway, that's a different story. But coming to the IPO of Deccan Aviation, the IPO was priced at around 150 rupees. I don't have the exact numbers rightly now in front of me. But what happened is, and at that time, the period was not 7 days or 8 days like that. I think it was about 15 days or so. The period was still not very large, like 3 months. But during this period where somebody has invested in Deccan Aviation, the markets fell significantly. Now, at that point in time, you can't do anything. You have to simply wait and see what will happen on listing day. And the company's share got listed at about 40% discount. Now, if it was offered at 150 rupees, it got listed somewhere around 90 rupees. And immediately started falling. So Deccan Aviation, unfortunately, was a company which never gave positive returns to the IPO investors. It never crossed 150 at any point during its lifetime. Till the takeover of the airline by Kingfisher, it did not materialize. Now, what I'm trying to highlight is that when you are looking at listing gains, you have to be mentally prepared that you can have huge setback when you are having listing losses. If you are invested in the secondary market, you see the loss and you are a trader, you can have a stop loss strategy and you say, okay, I will take this much of a loss on my chin and I'll get out. But that is not possible when you are playing in the IPO market. So it is very important for you not to finance your investments through debt. End of the day, if it is your money, then it is only the loss that you are going to pay from your pocket, from your money, that is still bearable. But if you have leveraged it, that means the losses or profits multiply. And that can cause a very serious dent in your portfolio. For those of you who are looking for the long term, let us understand why a company goes for an IPO. Primarily, there are 3 reasons. One is the company is looking to fund expansion. Ram Manoj Pani Puri Limited is not satisfied just with having branches in India. Now we want to go global. We will have our outlets in US, Europe, wherever. And for that, we need money. So we'll go for a public issue. So if I'm funding expansion, then obviously the focus will be on, okay, what are the prospects of this new investment? What what are the associated risks, etc. Just like you analyze any other company, we'll have to look at it. The second reason for going public is to provide an exit to existing investors. Today, a company takes shape as a startup, meaning some angel investors or venture capitalists, they come in and invest in the company. They handhold the company to reach a particular scale. And after the company has reached a particular scale, they want to get out and catch hold of other such growing upcoming startup companies. So these investors are looking for an exit. So when that is happening, it is an offer for sale. Typically, you will see IPOs having both the components. A part of the money goes into the company, which is used for expansion. A part of the issue is offer for sale, meaning existing shareholders are offloading it to new investors. And that should be a red flag for us. Why is this guy leaving the company? And if a company has come up with an IPO solely as an offer for sale, then we should be wary about it. Because the money is not going into funding expansion or diversification or any of company's growth, but it is simply providing an exit route to existing investors. That should, we should be wary of that. I'm not saying that those companies are not good investments, etc. But one needs to be careful, because an investor who has nurtured this company is getting out. So if that person is not seeing that prospects of further growth, then we as new investors have to be worried about. The third reason companies like TCS have opted for going public is for unlocking valuation. As a promoter, you want to show that you have so much of net worth, but if you are having unlisted shares, then it doesn't help. So companies going for unlocking valuation. In these cases also, you will see that there is very shallow information in terms of how the funds are going to be utilized. So a serious investor has to look into the utilization of funds for the purpose of IPO. Keeping all these factors, see, the basic thing, today the way the markets operate has changed, but being an old-fashioned investor, I would like to see profit in the company's books. If a company is making money, then I would want to invest. Our roots and wings philosophy comes at a much later stage. At the basic minimum, bare minimum, I want to see company making profit. But if we are having companies who are doing a lot of operations, you see their names everywhere, thousands of crores of revenues and double of that in spends. And there's a lot of cash burn, then I would be very wary of investing in this company. Maybe it's got great prospect. It's like a person, a person who has been a topper throughout in academics, etc. But till that person starts working and makes meaningful contribution, I will be wary of that, of putting my money behind that person. So do not, I would not recommend going for brands who have carefully built their brand and who are doing a lot of operations. I'm not saying that those are fraud companies, etc. But as an investor, the bare minimum criteria that you need to see is profitability. Looking at profits 5 years down the line, 10 years down the line, and investing at insane valuations is not going to be very helpful. So this is my view on IPOs. Be clear whether you want to be investing or playing the listing gains game, or you're a long-term investor. If you're playing the listing gains game, so be aware that there could be huge listing losses also. And one mistake that you should avoid at any cost is that you should not be funding it through loan. 3, avoid companies which are coming up only for offer for sale. If you are a long-term investor, put in time and study all that information that is there in the at least the abridged prospectus. Okay, and take help of experts who understand this language, and then take a call and stick to the company if you are a long-term investor, irrespective of what is happening on the listing day. So with this, Ram, I will stop, and maybe you can talk about your part and then go for question answers.
So Manoj, basically, just I wanted to clarify a couple of things for the audience here. Earlier in the 90s, there was a big issue of underpricing of IPOs. Aaj ke din mein, in the 2020s, and do you think underpricing is not an issue at all? In fact, the pendulum has moved to overpricing. What's your view on that?
Okay, so we are definitely...
1 minute, just take the Paytm, you can take as a case study when you talk about that.
So the days of underpricing are long over. Now, every promoter says that we want to leave something for the investor on the table. Okay, that means there should be listing gains. So you should understand there is something called GMP. What is GMP? Gray market premium. So today we have a market which is not the official market. There are people who are playing this game where they are trading on in shares even before listing. And this gray market premium provides you information about listing gains. So a lot of people go for this gray market premium information and then invest in IPOs. So somebody says gray market premium is this much, etc. Then they'll take that and invest. Okay. So while the promoter talks about leaving money on the table, etc., if you look at the valuations, at least in today's market, you will not see valuations which are very reasonable. Okay, yeah. Most of IPOs, particularly you took the example of Paytm. I avoid taking names, but a lot of these companies which are huge, big brands and who have done very well. There have been listing gains. Paytm, unfortunately, did not give listing gains. People who invested are still suffering. But there are many other companies who have given listing gains and the shares have been yo-yoing, etc. They're still very, very highly valued, overvalued. So I would say in today's scenario, most IPOs are actually overvalued. And the real test will come when we have a prolonged bear market. Unfortunately, for last since 2014, we've not, except for the COVID period, we've not had a very long bear market where shares have been, sliding down and testing investor patience.
Yeah, so there is a study that was done some time ago, a few years ago, which got published in the, I'll just flash that study in the International Journal of Financial Management. This is, I'll just show you the title of that. So this is post-issue performance of IPOs in India. It's a dated study by 12 years, but still it does cover a lot of swath, and it did have, that period also, reminiscent of current period, had a lot of ups and downs. So if you see here, Manoj has talked about, yes, there could be listing gains, short-term gains, but if you see this particular table here, the overall long-term performance has been only 7.4%. In fact, after 3 years, on an aggregate basis, there was a negative performance, and over a long-term period, only 7.4%, and most of that came from ITS sectors, which anyway had a great run till the mid 2010s. Now the industry is matured. So, and I don't have this study right now. There's another study that I think was done globally. Globally also, IPOs have given only about 5.6% return. Is a BCG or some study that I had read a few 2-3 years back. So a long-term investor definitely has to be careful. A lot of these are shiny things. Couple of years back also, there was a huge offer for sale by some companies. So I think that's our view. Basically, obviously, we're not taking any names as such. There's no need to rattle off trends. Everybody knows how many IPOs have come in India and what's the kind of there's that famous example of a showroom company trying to go and they raised about 3,000 crores with just a few crores of revenue. So I think that's basically what we wanted to cover. Why don't we take some Q&A now on this? You may want to chat. Either you can mention it online or you can just type it in the chat window.
Hey, Ram.
Yes. Yes,
Krishna.
Yeah, go ahead, Krishna.
Hey, Ram and Manoj, that was a good presentation. I did not know a bunch of those things which you mentioned. So good coverage. One thing is we all agree that these IPOs can be shiny, overvalued, and all of that. But every day nowadays, when I open my Economic Times paper in the morning, it's a full page ad on the front side saying it's a AAA rated IPO and all of that. So everything is a AAA rated, right? So how do we kind of distinguish that?
Yeah. So looking at advertisements is avoiding looking at advertisements is one way you can save money, Krishna. I mean, frankly, compared to what we've seen in the 90s, the advertisements also have got melted down. There's a lot of responsibility. As I said, there's a huge amount of disclosure that needs to be done today. But looking at, I don't know if equities are rated AAA, etc. But there used to be this riskometer which used to tell us about the quality of the equity IPO. Unfortunately, it did not cover pricing as an issue. Okay, so a company could be great, and yet if it is overpriced, then it is not going to be of help. So it might be rated very high in terms of the various parameters, and yet the company may underperform because of relatively high valuation. So the only way is to actually go deep and study the financials. And understandably, it is not possible for everybody to spend that much amount of time. So it makes sense for us to take help of professionals. So there are guys who are full-time into equity advisory, etc. And you can probably seek their services, and hopefully they'll do a good job of evaluating a company. Okay, but unless you see at the bare minimum, unless you see some profits already earned, avoid those issues. Maybe that could be your filter. Yeah, you might lose out on a lot of listing gains, but then you will not expose yourself to some bad investments.
Thanks, Manoj. I think a follow-up question on that, right? So if SEBI has put a lot of constraints and responsibility on the company going IPO to disclose, right? There should be a method and means by which they are getting rated. Each of these IPO gets a rating, right? So like I remember seeing all this. Even today I was seeing something and all this AAA rating. So it can't be some kind of fluff, right? So that rating has to come through some kind of an organized scorecard, which SEBI has approved or something like that.
That is how it is. Only thing is, the valuation does not form a part of it. See, neither SEBI nor you nor me is anyone to say what is right valuation. Just like beauty, valuation also lies in the eyes of beholder. So Aishwarya Rai wearing nakli diamonds can still earn lot of media coverage talking about the beauty of those diamonds, whereas a homemaker wearing real diamonds might not attract attention because the perception is, how can this lady have those kind of diamonds? So valuation is also a very, very perceptive thing. So nobody can value the quality of valuation. So that is left to the investor. We are giving all, what SEBI says is, look, I'm giving you all the information. I'm giving you last 5 years track performance record. I'm giving you projections. I'm giving you the risks to which this business is exposed. I'm giving you the management's response to how they want to tackle the risk. Now you decide whether you want to take the plunge in it or not. And nobody else can make the decision for you. And that is the reason why a scorecard, a quantitative scorecard cannot cover valuation. And that is our, see whether you, sorry for belittling this issue, but when you are buying a detergent, you know, a wheel, a rin, and a surf excel, all three wash clothes, but the price of surf is probably 3 times the cost of wheel. Now somebody will buy wheel and somebody will buy surfs, probably because of the perception that surf excel daag hai to achhe and whatever. And you know, you perceive that surf is a much better quality product and you're willing to pay higher for that.
So Krishna, AAA is only about creditworthiness. So it is whether, you know, you can safely lend the money to the company and whether the company has enough balance sheet strength to repay the obligations. But like Manoj said, valuation is a different thing. So, you know, so I think it's, to use Manoj's analogy, it is simply, does it wash or not? So AAA is basically, you know, dhoti hai kya? But, you know, the valuation is a completely different ballgame.
Got it.
Yeah. So,
thank you.
Yeah. It's actually redundant. I mean, they will highlight something which is not even material from a valuation perspective and the pricing of the IPO. So,
this is Mihir. Can you hear me?
Sure.
Yes.
Yeah. Thank you, Manojji. I think as Krishna rightly mentioned, some of the things you touched, we did not know. That was pretty interesting. So I have 2 questions. What we see, the trend now, as you rightly said, the popularity or the demand, and very recently I was reading, for example, arcade developers or Northern ARC. I read that subscription is more than 100 times.
That's right.
Right. So, like my first question is, do you see this trend continuing? That is one. The second thing is, if a company comes up for an IPO, even if the company is now fundamentally sound, very good company, given the fact that the subscription is so many times we are getting, and the chances of getting that IPO is also becoming very difficult. So how do you see that? On the first hand, is the trend continuing? And 2, if it is really good company, then what are the chances that one can get it? Then it is becoming very difficult.
Correct. So I'll answer that, Mayor. First, will the trend continue? Purely going by history, so long as the markets continue to give good returns, so long as we have stories of companies giving supernormal listing gains, this trend will continue. Okay, only when we have, when we see the markets taking a hit, suddenly you will see liquidity drying up. Okay, a lot of big issues are lined up. Okay, and therefore a lot more money is going to be raised from the primary market. So, and obviously, it is in the interest of everybody to have the markets, not get into a bearish phase. While it should not be done by somebody, it's not that. But I hope you are getting the drift. There is a lot of interest to maintain index levels, etc., by doing certain investments. So yes, this trend is likely to continue because going forward, we still have many big issues coming up. And we want those issues to be successful. And for those issues to be successful, investors have to see listing gains. And therefore, as long as the markets are up and there are listing gains to be made, people will invest. And you will have these subscriptions, high subscriptions. Now, if it is a good company, how do we ensure that we get allotment? Unfortunately, there's no other way. you just try your luck. Sorry, but that is I mean, we can get into the mathematics of it. We can make estimates. Okay, this issue has got that much of, likely to get oversubscribed 100 times. So if I have to get a chance of allotment, what should be my, obviously, if you're in the retail sector, the chances of allotment are higher. But then you'll have to gang up with so many other people and say, okay, each one of us will apply, and whatever gains are there, we will split amongst ourselves. So if 20 people apply and maybe 2 people or 3 people get the allotment, then you make some money. But I mean, personally, I don't do it because I don't see it worth. It's not worth the effort. Okay, but we still want to cash in. Then that is the only way, because this is a lottery game.
Yeah.
Other thing, invest and leave it to your luck or God or whatever. And if you get an allotment, you make a bounty. Okay, even on the minimum allotment, you will make a lot of money. Out of 5 issues, maybe you will get in 1, or out of 10 issues, you will get in 1. But there's nothing to lose, because worst case, what will happen? 7 days, your money gets blocked. Not a big amount. Not something that will worry you much, given that SB interest is hardly 4%, and we will see again interest rates coming down. Just take your chance. If you make money, great, enjoy. If you don't make money, nothing to regret. Try your luck in the next issue.
Yeah.
Sorry if I disappointed you with the answer, but that is the
No, I understand. I understand what the reality is. I think we all understand. Thank you very much.
Sanjay?
Ram, are you there? Or?
Yeah, can you hear me? My video is frozen.
Yeah.
Yeah. Did we have anybody else? I see something on the chat window. Let me just open the chat window. Sanjay Chakravarti is saying, you can read that, or Manoj?
Let me open the chat. There's one question above Sanjay Chakravarti. Sir, let's say I am looking for listing gains and shift that listing gains to mutual fund. Can I keep my money in savings at 3% interest in the hope of getting something at 40% gain? If I get 1 listing gain, that will cover for 8 listing losses, approximately 5% listing loss. Isn't the statistic in my favor now? So yes, based on the assumptions that you have made, the statistics might look in your favor, but then 5% listing loss. Deccan Aviation case, I told you, there was a 40% listing loss. Okay, huge. See, investor sentiment changes very fast. If a lot of people are looking at listing gains and that is not happening, and you see the listing losses huge, then those losses will multiply, because people have put in borrowed money, people want to again put this money in some other company, etc. So they want to exit at any cost, and therefore the losses are likely to be much higher. Okay, end of the day, there is, as in response to the previous question, I was telling you, these mathematical calculations can be made, but they are all subject to assumptions. My suggestion is same. If you think a company is good, just invest. Whether you make the gain and invest in mutual funds or not is a different thing. You keep it in SB, you keep it in mutual fund. Every investment will have its own pros and cons, etc. But if you are in the IPO business and you want to make money through listing gains, then there's no point putting in mutual fund. Keep rotating and keep trying your luck. Lagi to lagi, nahi to dil lagi. Okay. Question number 2. Company who have less issue size should have more chance of listing gains, as even with less demand, the price will shoot up. So this is a game of liquidity, but there are certain regulatory requirements that dictate issue size. Okay, which kind of company can go for what amount of issue, etc. Again, there are some regulatory provisions, but assuming that these regulatory provisions compliances is done, and the issue size is small, chances of listing gains are high. Conceptually correct. But during that period, if the market tanks, see, there is no rationality to market movement. The volatility is not driven by rationality. One negative news, one positive news will push the markets whichever way and to whatever extent. And therefore, if during that period the markets underperform and there is some negative news, some war, some interest rate hike, some political change, you will see a huge drop down. So we've had issues in the past, like Arcade, somebody was mentioning, companies getting oversubscribed more than 100 times and then getting listed at 20-30% loss. So issue size, these are, we can consider all that, but you are only playing a game of chance. Okay, these are no guarantees to that will tell you that if you do this, you will make money. And that is precisely the point I'm trying to drive home in this session. Okay, be clear about your objective. If you are going for listing gains, I told you 2 or 3 caveats, keep that in mind and play your game. If you make money, great. If you don't make money, TK, nothing happens. Opportunity cost is very less. If you are a long-term investor, doesn't matter whether it's an IPO or a secondary market, do your study, look at the fundamentals, be convinced, and then go for it. And then don't worry about what is happening on the listing gains. Okay, second question. No. So now can I take Sanjay Chakravarti's question, or is there a follow-up question to this?
Take that, then I'll quickly cover, long-term investing, quick summary I'll cover.
Since you suggest that studying the financial information about the IPO would be advisable, but it is cumbersome, so it is better to go with professional advice. Then how do you choose an IPO if we had to for an investor? So, sir, again, whether I'm doing it for an IPO or for secondary market, we follow our roots and wings philosophy. All of you are aware of that. Okay, we look for companies which can stand the test of a crisis and have the potential to grow when the opportunity and the environment is favorable. So those are, if whether it is an IPO or a secondary market investment, if it is meeting these criteria, we will go for it. Now, purely a secondary market investment is much better than an IPO when you are having this kind of perspective, because one, a lot more information is available. There's, for example, you can go back and look at management thoughts over last 2 years, 3 years, 5 years. All that data is there in public domain. So you can have a much better view rather than, merchant banker filling up pages and pages. Obviously, most of this information will be written in some rosy English, and therefore it is very difficult to actually call out things that can possibly go wrong. There is a section on risks and how the risk can be tackled, but a lot more effort is required. When I'm putting the same effort on a secondary market stock, I have a greater chance of identifying a winner, a consistent performer. Okay, so at a broad level, investing in secondary market is much better than investing in IPO. But if I have to look at an IPO stock, I'll apply the same criteria, same filters.
Be consistently high. Promoters should have significant stake in the game. We don't like companies where promoters put together have, very less share in the company. One example that I'll give, which is not very popular, is that of Infosys itself. Promoters put together today don't have a significant share in the company. Yes, they have a lot of emotional attachment and they have a lot of pull and influence on the stock, but God forbid, after a few years when they're gone, we don't know what will happen to the company. So the same. So on the wing side, again, we're looking for consistent earnings. The problem with many of the IPO stars of late is that earnings are patchy and they do a lot of dressing up for the IPO. They know that, there is a big bull market out there. So therefore, let's go and let's, Behti Ganga mein haath dho lete hain, as they say. So the earnings consistently, year on year earnings, not just the top line, but the midline and the bottom line are also very, very, very important. We also track the market share stability of the company. So, if there is a good company that is there in that, we don't mind. In fact, we have not, Manoj, you want to touch upon our view on unlisted? We have not done any unlisted so far, but that is something that if we are able to apply roots and wings and find good candidates, we don't mind investing in a pre-IPO company also, not just during IPO. But the worry here is again about the availability of data and the reliability of the data.
Again, maybe that is something that we have to take up as a separate session, because liquidity also comes into a play. Okay, yes. So particularly if we are investing in a PMS, or we are providing investment advisory advice, then liquidity also has to be factored in. So as you rightly said, if it is unlisted, then the disclosure requirements are much more liberal, and therefore a lot more effort needs to be put in. But yes, if we do come across companies which are providing that potential, and we see a way in terms of how liquidity can be addressed, then we can consider. Ram, we are already overshot by 8 minutes. So
So I think there's in the chat window, there is a survey form. If you could all click on that and just share your feedback, give us some thoughts in terms of what else we should cover next month. That will be helpful. Also, if you have any questions about any of these offerings, we'll be very happy to answer that as well. Okay, so I'll wait a few seconds till you're able to open and click on the survey link, and then we can close the call. Thank you, Daival, for the feedback. If you could give it on the survey form also, that would be great. I hope you all got the survey link. All right, thank you, everyone. Manoj, you can close the meeting.
Yeah, okay. Thanks, everyone. Have a great weekend. Happy investing as always. Bye-bye.